Festival, your session is about to begin.
Welcome, non-sun seekers. We're here to talk about content and capital, building and understanding the value of content industry assets. And those people who just want to sit out in the sun and do deals are going to miss some very interesting and enlightened people and some excellent perspectives for you. To start things off, I think it's very important that I introduce our group of speakers here who are very esteemed and very varied, which I think will give us some excellent perspective on the subject at hand. First of all, to my immediate right, allow me to introduce you to Stephen Lambert, who's the chairman of All3 Media America, which is a part of the All3 Media Group, which is one of the super indies in the UK that it comprises, I believe it's 18 or 20 different production businesses around the world, and is here in Banff, looking to meet the market and do deals, and we're very pleased that he was able to join the session. To Stephen's right, allow me to introduce you to Paul Sparks, who's Exec Vice Chair and Managing Partner of Difference Capital, a relatively new, publicly listed merchant bank that's looking at this sector and looking to try and indeed build content industry assets. So it's a pleasure to have Paul, who has an excellent public and private sector background, most recently at CTV. To Paul's right is Annette Brock, who's famous for having once done yoga with me, but in a large gymnasium with others. And Annette is a long-time financier and player in the media industry, and has worked in a couple of different significant organizations, currently at the National Bank of Canada, acting as a lender, which is one of the leading institutions here and probably known to many of you, and has an excellent perspective on the subject at hand. And finally, allow me to introduce you to Sanjeev Samat, who's the Managing Director of Canaccord Genuity. And Sanjeev runs their media and technology group and is one of the most active investment bankers in this sector in Canada and also internationally, and has an excellent perspective on the subject at hand. And I'm going to actually request a glass of one of the unencumbered glasses of water there so that I don't lose my voice in the mountains. Is everyone here drinking a lot of water? Put your hand up if you're not. It's time to change that. So who's in the room before we get going? Can I ask, how many people here are independent producers? How many people here are broadcasters? How many people here are investors? Nice, the volunteer at the back is an investor. Awesome. we aim to not disappoint. How many people here have other jobs that they think we would like to hear about, that would like to shout them out? That's what I thought. Go ahead.
Work on network development at the edges of the network, rural remote communities.
Okay, nice. Very good. Okay, so we have a good mix of people, but primarily people in the production space. And by the way, do feel free to move forward if you'd like to, because there is ample room in this room at this point in time. Okay, so you've all read this session descriptor, and what we really wanted to do here today was get a bunch of different perspectives on the value of content industry assets. What are they actually worth, and how do you actually build them? And we have, as I described, a whole bunch of interesting different perspectives on the subject at hand. And I think a really interesting way to start this session is the first burning issue question that we put on the website, which is, does capital think content is hot again, and if so, why? And to start the discussion, I'd like to turn to Sanjeev at the end to give us his perspective on that.
Sure. Maybe this would be a good time. I brought one slide, which I'll put up right now, as I was asked to, and nobody else did. This is a simpler chart than it looks like, as we were discussing up here. What this really shows is multiples, the valuation multiples over kind of a historical time from kind of the last decade onward. The reason I put this up is to show where the multiples kind of were kind of a decade ago, and you kind of see they were trading at about broadcast and entertainment companies and publishing companies are trading at about 10 times earnings before interest and taxes. And they kind of bottomed out in the financial crisis of 2008, and have somewhat recovered. But the interesting divergence here is you see the broadcast and entertainment group, and that includes companies like Disney, Comcast, Viacom, Time Warner Cable, etc. They've kind of stayed strong in the 9+ range. The traditional publishers have traded off significantly down to a multiple of 6. What this really begs the question of is, one, why is that? And two, where has the capital, what this chart is clearly showing is capital has gravitated towards the broadcast and entertainment companies. And it's kind of the topic of du jour here, why is that? And what we've really seen is an emergence of content and investors really valuing original content. And there's a number of reasons for that, ranging from the number of purchasers of content out there today versus even several years ago, led by the rise of digital content purchasers. And so we're seeing kind of this change in philosophy and emergence of different business models where everyone's trying to figure out how and where advertisers and consumers are going. At the end of the day, what they're really valuing though is content and original content and IP. And so I'll leave it at that as original.
Let me ask you about the slide. So what's in the list here? Was this Canadian?
This is a North American list for the most part. So the top line that you see, broadcast and entertainment, includes Walt Disney, Comcast, News Corp, Scripps, CBS, Cablevision. The red line is the publishing group, and that's the traditional publishers that are out there. McGraw-Hill, Dun & Bradstreet, Washington Post, etc.
Okay, so the argument is that content is coming back into view as a valuable, collection of assets?
Yeah, what we've seen, so this is the publicly traded comp group, and again, what the challenge we have is there's been so much media consolidation out there, particularly in Canada. If you look at how many publicly traded pure plays there are out there, there's very few. So by definition, we're using a kind of a North American group here, but it's happened in the States as well. If you look at trading multiples, or if you look at precedent multiples for transactions like Disney Marvel, if you look at where guys like DHX Media are trading, these are multiples well into the 11, 12 times range. And it's just really what I wanted to show here is the divergence between that content, original content, and kind of the publishing group and distribution channels, as opposed to the guys who are producing real content. And that's what really this chart highlights here.
So that's good news for people who are in the content business.
Absolutely.
So what's the caveat? The companies that you focused on have significant critical mass. And a lot of the people in this milieu do not. How does that work?
And that's a challenge. We certainly have seen capital gravitating towards the larger entities. What's happened in Canada particularly though is the consolidation has been completely rampant. You have effectively 3 to 4, it's an oligopoly of 3 to 4 content owners in this country. What's happened though is you've seen niche providers of content emerge and capital being gravitated toward that. I'll give the example of DHX Media because I've used that one just a few seconds ago. DHX Media, as some of you know, have some children's content. It was kind of a East Coast-based producer of children's content. Just a couple of years ago, trading at 3 times EBITDA and a market capitalization of under $25 million. They recently did an acquisition of Cookie Jar for about $100 million. The multiple for that company now is 11 times, and the market valuation is over $300 million. And again, the reason for that is size begets capital, and so that was one of the reasons. But two, people realized there's a pure play in the entertainment space that they could actually invest behind. And again, capital being gravitated toward that. So you're just seeing and there's other examples like that as well, but that's one that in the public markets where you've seen kind of examples where Canadian investors have kind of come behind a relatively small producer. Not everyone has to be the size of Chorus or Bell.
So what about private market values? How would they compare to these public firms?
Again, depending on where we see them, private market valuations obviously trail, by definition, public market comparables. But we have seen funding happen. We've seen our friend Paul here, funding companies like Thunderbird. You see Michael McMillan at Blue Ant raising money and being very successful there. What we've seen from our investor group is a clear desire for public market opportunities. That's where they're really coming behind and providing, there's more liquidity, there's more momentum, there's more opportunity for growth, and so we're really seeing where companies are coming together of sufficient size where public market investors can come in, and that's where we're really seeing kind of the multiple lift.
So public markets have been pretty silent or relatively quiet, depending, and certainly in this sector for a long time. Is that something that we're going to see blossom in the future? Paul, why don't you give us your perspective on that?
Yeah, absolutely. Bring up my pie chart.
You just drop it.
I think I have a chart back there that I'm going to throw up. Yeah, so this is why we started Difference Capital. And if you look at the three pie charts, December 31st, 2000, in terms of the weighting in the public markets for growth companies, which I call media technology companies, we're at 28% of the public markets weighting. And as we know, the tech bubble burst, and Canadian markets went into a real focus towards resources. And if you look at the second pie, resources is at 49%, and growth companies shrunk to 3%. But what's been happening in the United States is a completely different story. Growth companies in the last couple of years have been growing substantially. They're now 32% of the pie. And as we know here in Canada, the resources-based markets are stressed, if not distressed, at best. And so the reason why we got in this business, and we took over a shell that's traded on the stock exchange and raised a bunch of capital to invest in technology and media companies, is we believe that the pie is going to flip around, and that there is a $200 billion opportunity here in Canada in those markets.
Rob, I'll just jump in and kind of echo that. I mean, I think the chart lays it out really clearly, and we've seen this, from our own business. That we've been in a 10 to 12 year cycle on the resource side, which has been unbelievable. And the capital was overweighted there. You had investors who were supposed to be, broad funds who were supposed to be invested across sectors, who ended up, supposed to have 20-30% exposure to the resource sector, ended up with 60 to 120%, believe it or not, exposure to the resource sector. When that bubble, you can say it's burst now or is bursting, and what we're seeing is that capital quickly coming back to the growth cycle. If it came back to the yield side first, you saw lots of yield product being sold. You saw REITs in the real estate side, people just looking for single-digit yield. And after those opportunities kind of got bid up, now you're seeing the move to growth, and this is where Paul was really going. Technology, media, telecom, and opportunities for real growth, and that's where the market's going.
So in effect, in the public markets, there is now a scarcity of non-resource names.
Absolutely.
For which this group could comprise, in whole or in part, assets that could be used as public, or could be publicly listed as a way to find capital and get liquidity. Is that your assessment?
Absolutely, and it has to be, I have a particular interest in content. Coming from my background as CTV, we were always renters of content. Our biggest frustration is we were never able to own it. And content creators are probably more valuable today than they've ever been. It's not just about chasing the broadcaster anymore, it's about chasing all the different platforms that are out there. And we've got such a creative environment, great companies, but we don't have the scale. There's one or two companies that are doing it, DHXB and E1, but I think there's a great opportunity for roll-up in the content business to create another big powerhouse that can compete on a global scale.
Well, that's interesting. Okay, so let's turn to Stephen, because Stephen represents a very interesting perspective on this, I trust, because he works with a business that has gone and rolled up globally a whole bunch of businesses. And now that we've covered the public market opportunity and the sort of big picture where this is going, value discrepancy, let's drill down a little bit on just what conditions need to be exited in order to make a roll-up make sense and take place, and what the businesses that are components of any given roll-up might or might not be worth. Stephen, why don't you have a go at telling us about how the story of how Hall 3 built its enterprise and what lessons you learned along the way in terms of valuing and rolling up production distribution businesses.
Sure, thank you. Looking at the first graph, we talk about broadcasting companies, public listed broadcasting companies, mostly in the States. They're content and broadcasters as well, aren't they? I mean, there's a big difference if you're Walt Disney and you own ABC, or if you're CBS and you own the CBS network. I would call most of those companies broadcasters primarily, and content producers second position, or certainly equal position anyway. So I suppose the point I'm making there is that pure content producers or pure content companies that don't have the ability to either commission their own in-house content or the ability to broadcast their content, but are essentially content creators who are going around looking for buyers. Such groups have struggled on the market, on the public market. Certainly, the story of what happened in the UK is that in the early 2000s, there was quite an extraordinary thing that happened over quite a short period of time. Somehow, the independent sector managed to persuade government that it was in the interest of British business, the British economy, for the deal that had existed before between broadcasters and producers to be regulated in favour of the producers. Up to that point, the producers essentially were operating as serfs, and the broadcasters held an oligopoly on the deal, and they gave us very little. Essentially, they controlled distribution of everything that they commissioned, and they kept the vast lion's share, if not all of, the back-end revenues. Within a very short period of time, we managed to turn that round so that every show that was bought by a British terrestrial broadcaster, we kept the distribution, and we kept 85% of the back end, which was remarkable. It meant that the sector went from essentially a lifestyle sector that was making, on average, sort of 1 or 2% bottom line profits, to a sector, and therefore completely unable to attract any money from outside the sector into it, to a sector that was making, on average, sort of 8, 9, 10, even 12% bottom line profits in some cases, which meant a lot of money flooded into the sector from outside of it, mostly private equity. I was part of a company called RDF Media at the time, and we started buying new companies, and because we had some private equity money, but we then listed on the AIM market, and several other companies did the same thing. Maybe because we were all too small, in fact definitely because we were all too small, it wasn't a very happy experience being on the public market. We bought other companies using our paper at that point, but we just didn't get written enough about. And the companies that have been successful in the UK sector have been the ones that have been able to acquire as a result of having private equity investors. And certainly the story of All 3 Media, which benefited enormously from this change in the terms of trade. What happened was it was set up as a consolidation vehicle by some executives who came out of ITV. They had the backing of Bridgepoint private equity. They bought a company, a TV company from the Christus Group, which was essentially a radio broadcaster, and then went on to buy many more production companies in all genres in the UK. It's now the largest collection of independent production companies in the UK. It's also the largest in Germany. It happened as part of the Christus deal to own the largest in New Zealand. And our challenge all the time with all production companies that we buy is, what are you buying? Because on the whole, these companies are run by creative individuals who you can buy them on an earn-out deal, and you know that they're going to be locked in for a period, say 5 years. What happens after that? I think the big challenge for the consolidators of creative production companies is how do they keep the people that they're buying? What's to stop them going off and starting a new production company? And I think the challenge there is to make sure that when you consolidate, that you still make it attractive for the producers that value their independence and their creativity.
So how do you do that?
Well, everybody's come up with a different solution. If you look at what's happened in the UK since this terms of trade change, we've gone from a sector that was well over 1,200 independent production companies to one that's less than 500 now. And actually, 80–90% of the programs are made by one of about 10 groups of consolidated groups. Now, those groups are all doing different things. At one end, they're essentially cutting costs, amalgamating, homogenizing their acquisitions. And on the other, they let them essentially stay the way they were and keep them as individual companies that have their own culture. All three, Spain is the group that is most extreme in terms of operating the federal model. And that's been its success because it's actually had a very good track record of doing new deals with the creative founders of the companies it's bought.
What does a typical deal look like for all three? When you go and do a deal with a company, what's the structure, broadly speaking, that you prefer to do?
Well, we'll buy 100% of the equity and agree a percentage of we obviously value the company as a multiple of EBITDA, and then we will pay probably 50% or so up front, and then the other 50% will be done as an earn-out over a number of years, which the amount that will be paid will vary depending on the EBITDA performance over that period.
And what's the valuation range when you bought the equity?
I mean, as a sector, people are buying production companies in the UK and elsewhere from anything between 8 and 12 times.
8 to 12 times EBITDA?
Yeah.
Okay.
Yeah. I mean, certainly when
and these are content assets that don't have distribution as part of their
they do not have the ability to broadcast. They obviously don't have distribute. We have.
That's what I mean. Yeah.
They don't. No. I mean, News Corp paid with public record about 12 times EBITDA for Shine, which.
Now, why are they doing this, and why are you doing it? Do you see incredible growth that justifies that kind of multiple?
We've had a good track record at buying companies that have organically grown very effectively over the period. We're trying to create a large content group and agree that scale is important to value. There may come a point where a group like all three could list. I actually think we're still not big enough to really list properly, because we certainly shouldn't be listing on the AIM market, we should be on the full market. And I think that if you consolidated two or three of some of these large groups, I'm thinking of, I don't know, there are obviously groups that are out there that are operating in this space. I think that would be large enough then to list on the full market. You need so much scale that you can cope with the ending of your valuable franchises, so that you've got others coming up and replacing. And that's the big challenge is A, how do you keep the creators? And B, how do you ensure that those creators are coming up with new ideas? Because the successful titles that we have in a group, and every other group has, if they're very successful, they may last as obviously the secondary value, but as a production value, the show that keeps getting ordered. If you get 10 years of life out of a show, that's great. But when it suddenly stops, if it's making a big contribution to your numbers, that's a big hole to fill.
Interesting. So you're an advocate of scale, absolutely, because if you're paying that much, to get the lift in valuation, and if you're paying 10 to 12 times, you need to have a valuation or a growth factor of some order in order to justify that. And if you say that you're not big enough to be going public, and what's the sort of level of revenue you think a company would have to be in the context of your sort of UK domicile to justify being
£1 billion of turnover.
1 billion pounds of revenue.
Yeah.
Okay. Okay, interesting. Otherwise, the AIM market, which has had issues with liquidity and valuation, is not something that you would. I used to be chairman of an AIM company, so I understand some of these issues firsthand. Interesting. So let's jump to where the rubber hits the road, because we have the benefit of Annette Grott here, who's a lender and who gets to look at the soft belly of every enterprise in this country who are looking for the finance to carry on in an orthodox way. And could you give us your perspective when you look at these companies in light of some of the comments we've had about the public opportunity? In Canada, it's arguably a different opportunity than in London with respect to the public markets here, and a mid-cap here is a small cap somewhere else. So that's an interesting contrast of perspective. But aside from that, where the rubber hits the road at an operating level, when these guys are earnest and respected colleagues here are out financing their production, what are you seeing in terms of how they're financing themselves and your own perspective of value in this sector?
Sure, absolutely. Well, as a lender to content providers, that is our core business. So content, I can speak to the importance of content sort of indirectly. Our bank has been doing this for approximately 12 years, and we started in the Canadian market financing typically Canadian, like a financing structure that's typically Canadian, with tax credits and Canadian broadcast contracts. Now, over time, we've become increasingly global, and we're following that market. So now our business has changed. Our overall portfolio has grown. So I think the importance of content is growing, following the change in the landscape. But it is becoming increasingly global. We are now financing international pre-sales as well as providing a product called GAP, which is a more risky. We support the content providers based on projected cash flows from sales in international territories. So that allows them an increasingly global sort of perspective. And up to this point, we haven't really been able to figure out a way to finance digital. We can only finance contractual cash flows. So the idea of selling apps or various other sort of digital monetization opportunities wasn't something we could typically get involved with until very recently, when in one of our standard financing structures, we financed Netflix, which is something that is, our due diligence literally took a nanosecond. We take a look at this from a credit perspective. Now, what's interesting about that contract to me is that it opens up an entire new cash flow for content providers, I think. The amount of the contract was significant, much higher than other windows that we're looking at, much of it higher than new windows. It's also non-exclusive, which is something that content providers typically, I don't think, face. So they can actually syndicate through various digital opportunities, and I think that increases their potential for future value for the public markets and the valuations in terms of the cash flow streams that they can retain. As far as roll-ups go, I think that's another thing that we are seeing within our client base. There are companies who are announcing publicly that they're looking at smaller producers. And of course, so my role in that is we have change of ownership clauses, right? So that is something our credit group is becoming more familiar with, more open to, and we're trying to support our clients in that way as well.
So you would advocate, and as you as a lender, it would be better for your business if there was a consolidation underway in the Canadian perspective?
Well, it's having a strong client financially is always a good thing, and so yes, I think it would be a good thing. We'd like to bring up new producers as well, but dealing with, we can deal with companies that literally have 1 or 2 productions. So very, very small, up to much larger public companies who actually have syndicated lines. We may or may not be part of those, but we support them as well with production lending.
How does access to credit differ between the smaller players and the bigger companies?
It is purely a credit decision based on the project. It's project by project financing. So those projects are generally supported by some sort of corporate guarantee, and the stronger the corporate guarantee, the better the pricing.
So the underlying credit risk is not with the producer in any event, it's with...
is with a counterparty. So, for example, if we have a contract from CBC, that drives a fairly low pricing. If it's if we're financing international sales to, let's say, a distributor in Russia, that's problematic for us. Just as a little anecdote, I recently tried to. Well, I've got a large feature film that has about 20 international pre-sales, and one of them is to a Russian buyer that has his money going through Cyprus. That was that's a no-go with my credit guys, right? So, but in other senses, I mean, we're seeing a lot of cash coming in out of the digital area in a very traditional financing model. So I think it's very optimistic.
Interesting. So if we look at the and by the way, did you have a slide you wanted to share with us at all, Annette?
I did. I could wait though. It doesn't.
Okay. You wait for the right moment to jump
I'll wait for
in.
the right moment.
Okay, well that sounds good. So let's talk about what a business is worth. We've been talking about the multiples, and it would be good to get a bit of a perspective because Stephen is a monster ant relative to what's going on here in Canada. It's a very different perspective. But I kind of wanted to cover that discount to critical mass that we have here, and in terms of some of the producers who are in the room here, trying to figure out what's my business worth and how do I value it. I mean, what's your advice? I'll ask you as a group to the producer here in terms of what their business might be worth in light of what you described, because I think many of them would be at the smaller end of the scale. And I'd also like to get perspectives on the value of a library and how that comes to play with respect to the asset value of the content business. Who wants to have a go at that first?
Why don't I start? I 100% agree with the comment that the smaller producers are at a disadvantage and a discount in terms of valuation.
How much of a discount?
Well, let me start at the other end, and then we can come back and talk about what that discount is. What the ultimate question is it's access to capital and the cost of capital. That's really what it is. And so when we talk about whether someone's small or large in terms of their library or the number of productions or revenue base, at the end of the day, the question we're really asking is what's the cost of capital? And I think just coming back to some of the comments we started the discussion with, I'm not here suggesting public markets are right for everybody. What we're seeing right now, though, is in Canada, the public markets, because of that shift we talked about from the resource side into growth opportunities, certain types of media companies can get access to financing in the public markets, and that access to capital is at a cheaper rate than was otherwise available, and
cheaper than private capital?
It's at a higher valuation and therefore cheaper than a private valuation.
So that's
a very unique. Yeah, that's a very unique time we're at right now, because I wouldn't have said the same thing a year and a half ago. I wouldn't have said the same thing a year ago. But we're in this unique time when that access to capital exists. So who does that apply for? I don't agree that it applies to small independent producers who have one or two productions. If you look at where the capital is flowing to, it's in terms of seasoned operators, people with a track record. So again, not to use the same example, but Thunderbird. Yvonne goes to Thunderbird. You got Frank Juster. You've got repeat kind of entrepreneurs going in. Michael McMillan and Blue Ant. You're seeing E1 in terms of an independent outside of the Bell, Chorus, and Rogers, and that's where capital seems to be flowing. And so again, at that end of the spectrum, people are getting valuation, people are getting access to capital. At the other end, I think it is a dichotomy right now, because that's not to say because capital is flowing there, it cascades down. In fact, capital is looking for places it can find a home and where it feels comfortable, because a lot of this money is new money coming into the system. There's not a familiarity with media, there's not a familiarity with technology, and so they're looking for proven performers. And I think that's where it's almost two houses here we're talking about. We're talking about the haves and the have-nots, and I think unfortunately some of the smaller producers still are struggling to find capital.
And if I could just say that, we've been in the media industry for a long time, but we would still love to do business with Thunderbird. But I see that Barb Harwood has left the room.
This is not a...
Barb Harwood was in the audience, she's escaped out there.
But this, just back to Stephen's point, what happened to AIM, and one of my partners was in London at the time, brought a lot of Canadian companies to AIM, and some succeeded and some didn't. But this is not the gold rush to the public markets. We just can't rush to the markets and expect to win, and some that have gone too early have lost. And when they're in, it's a different world in public markets, and when you get in and you lose, it's hard to get back the valuation. So what we believe in terms of our investment policy is to build scale for one, build that critical mass of expertise and people. And you don't necessarily have to go out and buy everybody either. I don't think that you need to do that. I think there's a lot of like-minded people in this country that want to come together and build something bigger. And that's the strategy that we're in.
So it's interesting. So having the benefit of Stephen here, is this an international opportunity for the Canadian sector, or is this a domestic opportunity with respect to this capital availability and Annette's talking about credit markets and their perspective on the projects that are coming out of the producers and more digital and GAP's a healthy business because your risk is tamped down. Is it an international or a domestic opportunity? And then I'm going to ask Stephen to comment on how he reflect on that from what he's learned.
I think from the content production side, it is a global opportunity, absolutely. And a Canadian company, and we've seen that with E1 and others, can be global very quickly. And from a public markets perspective, you can be global and be on TSX.
Will Canada, the Canadian public markets, support a global play of this nature? I mean, DHX is one.
DHX is one, but if you go back to the pie charts in terms of where the opportunity is, we're in a hot market right now, and it's not a short market either. I think it's a longer run, and Sanjeev can speak to that a bit more. But this is not something that's going to happen, within 2 years and it'll be over. I think that our lives have changed. We're now content. We're not content providers, but we're consumers of content. Everyone has an iPhone or a BlackBerry, and every minute of the day we're on the phone, and we're searching content. And you find the ad dollars is leaving what I call traditional media and is moving quickly into the internet, into mobile television. It's not that old media is dead; it's that we've got a bunch of younger kids to deal with over time. But it's very complicated.
Stephen?
Yes, it's always much slower than we think it's going to be, the move into digital, from the point of view of the producer that wants to try to find money to actually make their shows. Television is amazing at being able to consolidate an audience in such a way that advertisers give them large amounts of money and then they give those large amounts, or certain amounts of money to producers to make the shows. It's quite hard when you try and do the same thing if you're setting up a YouTube channel or something. I go back again to the distinction between a content creator who is also a broadcaster, who also has distribution, who essentially can do a deal with themselves, and it's a completely different world to a content producer who is selling to other broadcasters, who's selling to broadcasters who doesn't have the means of distribution. Because there, it's all about your ability to do a good deal. And I talked earlier about what happened in the UK. That certainly is not the case in the United States, which we see as our biggest growth market by far. I mean,
you mean the terms of trade that you were able to achieve in the UK?
Yeah, I mean, there are no terms of trade in the US. Every deal is its own deal, and that's why you need scale, because you need to build precedence with your buyers. We've just changed what we were doing in America as a group. Until the end of last year, we were encouraging all the companies in the group to go and set up their own operations in the States, which obviously spoke to our federal model. We realized that was probably not the best way about going it. Instead, we turned the company I had started in America, Studioland of USA, into All 3 Media America as the production entity for the whole group. Because we're trying to keep the federal idea of creative individuals developing and having their own selling relationships. But at the point of a sale, we want one entity to be the production entity and also to do the deal. Because you build up great deals with the buyers, and you can't do that as a startup. And That's certainly a huge advantage you have through scale. Just having more leverage in the market. And of course the other thing is having original ideas that people want to buy where there are multiple bids. That's the point at which you start having leverage, is when people, more than one buyer wants you and wants your idea. And that's something you can achieve in the States in a way that's quite hard elsewhere. There's much more of an expectation that you will take an idea out to everybody, and if they like it, they will all make a bid. And that's quite unlike most other markets that we operate in, where you tend to sort of get into a cozy relationship on an idea with a buyer, and you sort of develop it together. And of course, once you get a good deal, then all these other things happen afterwards. I mean, obviously something like Netflix is fantastic for owners of content, but a lot of producers will lose all ownership when they do their first sale.
What territories are you looking at as all three in terms of acquisitions? Is Canada interesting? Are there more acquisitions in the US?
We're pretty focused on the US at the moment. I don't know enough about Canada, which doesn't mean to say that we shouldn't. And I probably will learn more about Canada being here this week. But no, we're very focused on the States. We will make acquisitions, but probably also rather we are interested in startups. There's been so much consolidation of the independent production sector in the States and in the UK that we've gone from a situation where there were a lot of sellers and not many buyers to a situation where there's a lot of buyers and there aren't that many really desirable sellers.
So that's an interesting perspective. So let's turn to Canada. The three of you, why haven't we seen consolidation in the Canadian production industry, and why is it now different?
I think content, my earlier point, content has not been so valuable as it is today. And I think you're going to see a roll-up in the next couple of years, and it's going to happen fast.
Do you think the sellers have a reasonable expectation of their value? Stephen's talking about 10 to 12 times EBITDA.
I said 8 to 12.
8 to 12, sorry. Eric.
I'll take a stab at that. I do think the multiples for Canadians are different, and part of that is because I think Stephen's referring to primarily European companies that have a much larger base on which they sell. If you look at a lot of the Canadian
and different library cash flow perspectives.
Exactly, and so this goes back to the comment you made earlier, Rob, which is, is this an international opportunity? I think it has to be. So the Canadian producers who take advantage of the tax incentive regime that's in this country are produce cash flow primarily because of the tax incentives. And I think where those multiples will go to the 8 to 12 times is when they have international distribution, and when they take advantage of that and become truly international opportunities and move away from the tax incentive basis of operating, then we'll see those kind of multiples.
So that's a 1-2 killer punch, which is one of our questions. Are they leveraging from the Canadian funding regime that your view hasn't been fully unlocked and yet it has potential?
Yeah, I mean, I think again, maybe I'm overgeneralizing here, but for a lot of the small producers, they make a living from it. I mean, that's how they get into business. And I think what we're seeing is, as some of these companies get scale, that kind of that pays for your kind of Canadian cost of operation. And then if you can get international, and if you can have real IP that you can sell internationally, that's really your gravy, and that's where you can make turn real cash flow.
And that's exactly my experience as well. I mean, with a lot of the companies that we're dealing with that are getting larger, they're keeping their IP. And for example, getting back to the Netflix, they can make that Netflix sale, keep the IP, and that's over and above the budget of the film. I mean, there's excess cash there. The other thing that, I mean, in terms of the roll-up, well, sorry, sorry, Robert, I got totally confused. So we're seeing more and more interesting financing structures. We're seeing more access to capital, more access funding in terms of the specific projects. And so the companies really are, I think, retaining that cash flow. And as far as the public markets go, I don't know, how long it takes to develop those high multiples. But if you look at the, I think, Canadian industry in general over the last even decade or 15 years, I mean, there were a lot of public companies, like, the Alliance Atlantis of the world. And that whole landscape has changed. There was a bit of a lull through, the financial crisis, but those companies are still there.
But since the financial crisis, isn't it 3/4 of the market value has disappeared from those public companies, and so that's part of the thesis that it's going to return?
Yeah, I mean, depending on which group you're looking at, it's either disappeared or been bought by larger companies. So, but yeah, that's exactly what the thesis is that a lot of that value will return into the market.
So let's go back to something, because what Stephen suggested is that in terms of trade, that they had an industry in the UK 10 years ago that was very much like ours, or however many years ago it was. And then the new terms of trade deal that enabled the British producers to hold on to more of their IP was, as I think you characterized it, Stephen, the catalyst, which enabled the evolution and development of larger enterprises to move forward, which in your characterization was a win-win for both the producers and the broadcasters generally. Here in Canada, a year and a half, 2 years after the terms of trade deal, the Canadian broadcasters are already making noise about having an interest in renegotiating that, which would take us in the opposite direction to where you have gone.
Yeah, I mean, the broadcasters went wild about it in the UK. They did everything possibly good to stop it from happening, but remarkably they failed. And they have lived with it to a large extent. They're sort of nibbling away at it. It's also partly tied up with the fact that it was a deal that was for qualifying independence, and these were companies that were not part of a group that also was a broadcaster. As a result of the consolidation that then came about over the next 10 years or so, a lot of companies consolidated, and those consolidated groups then got bought by really big groups, like a News Corp or a Time Warner, and so they stopped becoming qualifying independents, which means that because they're so big at that point, they are able to hold on to those established terms of trade that are so favourable, even though the broadcasters aren't required in the same way to follow them.
Interesting. So, in terms of the consolidation here in Canada, can it happen privately, or is it a public markets opportunity? Even with the smaller enterprises.
Well, first it starts privately, and absolutely. See where you go from there.
And then, with respect to that, then I think it would be good to cover libraries, because you've seen a lot of them. Maybe you could give us a quick précis on the library valuation and what you're seeing. Are the libraries of the Canadian producers of real value, and will they have increased access to be able to unlock that value from what you can see with some of the distribution deals that are done?
Well, that's actually a very interesting question, because we haven't financed a lot of libraries. We see a lot of valuations, but unfortunately we take a discount on the third-party valuation of the library. And at that point, the number is so low that
it's always a fire sale value.
It's pretty well, fire sale value. So now I don't know. I mean, those are obviously static. There were a lot of assumptions. So I think
that's as a lender.
That's right.
So
right.
Can you give us some perspective then on the valuation of a library? For you as a lender, you look at the fire sale value for your security in any given financing that you do. From an equity perspective, what's a library worth?
From an equity perspective, well, I mean, we don't play in that equity world, but I mean, I would tend to think that what I would take a look at are the new digital, monetization opportunities. But how do you value that? There's a lot of uncertainty out there. Direct to customer, we certainly can't finance that. That's not something we can do. But if you can convince Sanjeev or someone else that the cash flow streams are there, those values I think could again I think it's based on your relationships and how two companies work. Are there content synergies? Are there relationship synergies between the talent within each of the companies? So the library itself, having to go through each individual title, are there tax specs there? Can you sell it to iTunes? Like, is it what are the repackaging, repurposing costs associated with it. So there's just so much uncertainty. It's not something that we can directly get involved with.
Right. So, but discounted cash flow model.
Oh, in terms of, yeah.
Looking at the forward earnings, classifying the titles, evergreen.
Right, so you estimate the ultimates of every title. So you take a look at the existing catalog library, take a look at their pipeline in terms of what their production is. You discount those cash flows, and again, the discount rate is, that's something to be negotiated. Do they have third-party titles like in there that they've licensed or acquired? And what titles do they distribute? When do those rights cease? There's so many. They're just it's having to go through that entire process. I think from what I hear, I think there are a lot of libraries out there that do have potential value. Can you unlock it in terms of the talent? Do you have the ability to sell into those digital markets?
That is the question. So I want to cover something I think it's really important. What are the most important things that a media industry player should understand in terms of thinking about their business as an asset building exercise, and how should they conduct themselves so that they're maximizing the opportunity to build an asset into something that's real, as opposed to something that is, that is you're working for, say, a producer fee, or it's a lifestyle business or something. What do you think about to make that transition to the real deal, Paul?
Well, it takes a different way of thinking, obviously, from the traditional way. And first of all, it's about what do you want to be when you grow up? Who do you want to be with? It's not about chasing the broadcaster anymore. It's about doing other creative things, and it's about scale, and not sitting back and letting it happen in front of you, just being part of it.
Stephen?
Have a good lawyer.
I'm a good lawyer.
I think if you're a content creator, it's all about the deal you do at the point of initial sale for that idea. You
don't sell your soul for rock and roll.
Well, I'm not talking about selling your company, I'm talking about the individual production ideas. You've got to somehow create it, yeah, sure. You've got to make them want it enough to give you a deal where you have a real interest in it going forward. And preferably you want it to be an idea that has a long life, and that is, every idea, the genres are different. My main knowledge is in non-scripted, although as All 3 Media America we are moving into scripted, and All 3 as a whole is 50% scripted as a group. But in non-scripted, if you have a format that you can make all over the world, I created Y-Swap and Undercover Boss and shows like that, and the ability to sell those to a broadcast network and then subsequently make a cable sale in the States for the rerun rights. Those are the two times that's happened for me. Y-Swap to Lifetime and Undercover Boss to Discovery. Those were easily the most lucrative deals I've ever done. That's the...
Was there a small thing that you did right that lets you hang on to appreciable asset value relative to what could have happened?
Well, in both cases, they were shows that were already sold in the UK as formats, and started making them in the UK under the terms of trade. So we controlled those formats, and we were able to say when we pitched them to the US buyers, this is something we already own. We already have the format. Do you want to buy it? And we were also able then to do a good deal on the secondary exploitation of the finished programs that we were going to be creating for them. So, I can't underestimate what an amazing difference it's made to the whole global industry in the world I operate in. What happened with the terms of trade 15 years ago, or however long ago it was.
Interesting. Sanjeev, producer comes to you. You look and producer says, "Yeah, I want to build a real asset here. I want to get bigger. I want to get serious about this." What's your advice to that producer?
go away and get bigger. I mean, it really does come down to, it's hard for us to make judgments on, a one production or a two production. We're really looking at, the history. We're looking at real revenue. We're, by definition, where we come into play is later stage companies. Either later stage private or public companies. And, we try not to make judgments about the quality of production. We let,
What size revenue?
Well, I think it really depends, and I say that because we've taken a kind of fairly traditional perspective on this panel in terms of, well, there's content producers, and then that kind of works its way through the distribution scheme, but we're in this really exciting world right now, where there is so much capital going, and so many different people doing so many interesting things. So you take that world where there's content being produced in this traditional sense, but then we have content aggregators now that have emerged, and that takes the form of anything from Huffington Post to Pandora Radio or Spotify and the music side. So you're seeing all these amazing models of content aggregation where people are saying, we want curated content because there's so much content. Anyone with a camcorder or an iPhone can produce content now. So help me decide where that content, what content I should view.
So if the story is exciting enough, the revenue doesn't matter?
Well, to a point, because we've certainly seen companies on the private side get funded, certainly on the social media side, on the aggregation side, very little revenue.
So just to finish on the public thing though, just to put this in context, what's the minimum size of revenue a company needs to have in order to be of interest to institutional investors and have some stability and liquidity and...
Rob, I was doing my best not to answer that question. If you ask me that directly, it makes it very hard for me to avoid that. It really does depend, and I'll say that because certainly Stephen has a perspective from a European perspective that it's $1 billion. Billion pounds, or
in Canada, in your context.
Yeah, I would say it's substantially less than that in Canada, and I don't know where it would be, but it's certainly well north of 40, 50 million, probably around 100 million would be a good starting point in Canada.
That's where I think it would be.
Would be a good starting point for someone producing content, and a path to cash flow from them would be a good start.
Okay. Anybody want to make a question or a comment to our esteemed panelists?
Hi, I'm just wondering, you talked about multiples with regards to Europe 8 to 12 times. With regards to Canadian companies, you said if they had international appeal, it would be worth close to the same thing. What would a Canadian production company be valued around in terms of multiples? If they're just based on the soft money turnaround in Canada?
Again, there's so much that goes into it. I make it trite and I will throw out some multiples, but again, keep in mind, a lot of it comes down to the sponsorship, who's around the company, the growth rate of the company, and the stability of the cash flows. But we've seen in Canada, anyways, production companies of the type that you talked about, 5 to 8 times EBITDA multiples would be kind of where those kind of smaller production companies would sell.
Very good. Anything else? Well, we ventured here long enough. Thank you very much for sitting through a very interesting discussion, and I very much appreciate the time of our esteemed speakers. Thank you so much for your time. Everyone enjoy the rest of the festival. And the speakers are here to chat with you.